All right. Hello, everybody, to a very boring week in the world of stocks and finance. We're really struggling to figure out what are we going to talk about this week. I want to talk about You on Netflix because the season 4 part 2 came out. I thought that would be a good intro, but apparently there's this bank thing that there's this thingy thing that ended up collapsing, and so we're going to lead off with that. No, I'm just joking around. So let's get into this. Silicon Valley Bank has failed. I want to share my screen very quickly and share a paragraph from Matt Levin, one of the OG business writers of all time, just to kind of give some context for those who are still missing out on what the story is, what happened. And then we're all going to give our thoughts, dive deep into it.
Do you mean Levine?
Okay.
Cool. Do you mean Levine or Levin?
Levine, whatever. I don't know. I don't know how to say it.
Good start.
Okay. So he says, if you were the bank of startups, just like if you were the bank of crypto, it turned out that you had made a huge concentrated bet on interest rates. This was 2021. Your customers were flush with cash because startups kept getting funded. This is the Silicon Valley Bank, so their main clients are startups. So they gave you all that cash, but they didn't need loans, so you invested all that cash in longer dated fixed income securities, which obviously are giving better rates than investing in equities, which lost value when rates went up. This is where the Fed bumped up interest rates. But also when rates went up, your customers all got smoked because those startups didn't really deserve all that funding. This was the boom and bust of 2021 because it turned out they were creatures of low interest rates themselves. And in a higher interest rate environment, they didn't have money anymore. So they have to withdraw their deposits from the bank. So you have to sell those securities you invested in at a loss, about $2.5 billion of a loss, to pay them back. Now you have lost money and look financially shaky. So customers get spooked and withdraw more money because they don't want to keep their money in a bank that's going to go under. So you sell more securities, so you book more losses, oops, and ultimately you collapse after Jim Cramer says that you are a good buy. And that's what happened. So this obviously affects the world of fintech, obviously affects the world of banking. This is going to be huge. It's going to have huge implications. It really hurts startups because half of startups in the United States that are funded by VCs work with Silicon Valley Bank. Let's start off with you, Tannor. What was your first reaction when you saw this news, and how are you thinking of it as it's developing?
Gary Tan said that it could be an extinction level event for startups. I think that's a little bit of an overreaction. I think that it's just going to shift who the big players are. But this is massive. This is going to be a lot of pain for a very niche but important, sector of the economy for innovation. You look at very specific investors like ARK Invest, who I'm sure a lot of their plays are very heavily in SVB. This is going to be very tough for them, even very specifically, just so that everyone's aware, okay? Silicon Valley Bank is the 16th largest bank whenever it comes to assets under management, but they also deal with a very specific niche, okay, which is, VCs. And some of these VCs, like I was talking about with Gary Tan, Y Combinator, whenever they're investing in these startups like, potentially a MITS company like Audia, they might even put in their term sheet whenever they're investing saying, hey, you need to bank with SVB because we don't trust anyone else. And then whenever the trusted source, who actually, this wasn't due to any scam or any terrible banking, it was just a lack of lack of funding for a very important area of the economy, that they go under, right? And we can talk more about why that actually happened, but this could be very bad for a very important part of the economy, like what Amit is trying to do right now.
So, okay, let's just level set for a second, because there's, I think, a couple of people that are just like, okay, wait, we jumped right into this. Why are we talking about this? This is the biggest banking crisis since 2008, the second biggest in U.S. history. And since this is the bank that really deals with a lot of tech companies, a lot of startups, there's a couple of different areas that I think I'd love to, hear the group's thoughts on. Number one, as I was learning about this, was contagion risk. Like, what effect does this have to domino down to other financial institutions, but also to domino down to tech companies like, Roku, which we'll get into in a second. And then a conversation that I've been seeing on mainstream media is a potential buyout candidate. The capitalization is something else. So really, in my mind, I mean, Tannor, let me know if this is a horrible comparison, but what FTX was for crypto, it seems to be that this is for major financial institutions and tech companies at that magnitude of chaos, let's say, in the markets. So it's very important and it's very relevant to not only SoFi, but the entire fintech space. And moreover than that, the entire market in general, because of how many different lines of connection there are between SVB, Silicon Valley Bank, to everything else in the market.
Yeah, I would say you're completely right. I mean, lower the scam level and increase the reliance level for the overall market. SVB was a critical point, very, centralized player. And that what we're realizing is that once one of these players actually goes down, that you're realizing how little players are actually this niched up in this area, right? And now, what I actually think is funny, and maybe we can talk about this as well, is the contagion is looked at in two ways, okay? One, we can look at it as what is the biggest buyer of financial institution companies? And funny enough, it's financial institutions. So a little bit of the contagion has to do with, I guarantee you, JP Morgan had exposure, Bank of America had exposure, Credit Suisse had exposure. They all will have exposure because that's part of their diversification, is buying a whole bunch of banks in an industry that they love. But obviously, a big problem with that is that, you know what, whenever one does go down, you do get caught. So either you're fully centralized in an area that doesn't go down, and then you look like the smart guy, or you diversify and get a 5 or 10% hit whenever it does go down. Regardless, the alternative to the contagion is maybe a good one. Whenever we're actually looking at, and this is why I wish Kris was here, First Republic Bank, JP Morgan, a lot of these companies that also do serve, VC, companies, there might have been some issue before this company went down, but now you have a massive new stream of deposits that are actually coming to, First Republic Bank, Signature Bank, Pacific Western Bank. These companies were also lacking deposits, but because one of their peers actually fell, that's $42 billion that just rushed out of that company and going to the competitors. So they are probably also seeing right now a huge rush of deposits because one of them actually fell, one of the top pillars.
Okay, and we got Kris right on time as he's getting in here. Kris, we want to get your thoughts on everything that's happened. First, let me give a shout out to George Manassas. Thank you for the $20 super chat. Means a lot. He says, good evening, everyone. In your view, does the SVB situation get us closer to rate reductions? Kris, how about you answer that question and then give us some of your thoughts on FRC, as Tannor just mentioned?
Rate reductions, no, but it does definitely take away a lot of the... Who the hell is calling me? All right, whatever. It does take away from a lot of people probably expecting rate rises fast. I don't think it's going to happen as much anymore. I know a lot of people are thinking that, hey, we're going to see a 50 basis point raise. I don't necessarily think that's going to happen. I think we're definitely going to see a 25 basis point increase, which, believe it or not, is sort of bullish because I think the expectations have gotten a little bit ahead of themselves now. So, yeah.
Two things. There's a do not disturb button you can press. It's pretty quick. And secondly, do you think that there's going to be a bailout, Kris? That's a big topic of.
I think that's where I was going to, because like on the rate reductions, it really is a facet of how bad this can get downstream. And I think a bailout, along with contagion, are two things that really lead into that.
I mean, the question is, bailout who?
Bail out the depositors.
Yeah, depositors.
Right? Like not the bank, but the...
Well, first of all, there are assets in the bank, right? So there's no real need to technically bail them out.
They had negative $985 million yesterday, apparently. So I guess...
As what? The calculation for it? Like based on the treasuries?
The reserves that they had for the deposits.
Mm-hmm. But in terms of liquidity, is that what they're talking about, or is it just like overall? Like
I think
just
that's
have
liquidity.
a balance.
That's liquidity, yeah.
Yeah. So the thing is, remember, all of their money that they have is in treasury. So these guys, this is where they really messed up. They took money in the short term, right, and lent it out in the long term, which is fine. Everyone does that. That's how a bank works. You give them money today, they take that money, lend it out to other people, they make an interest on it, and they give you some of it back. And that's how banking works. Problem is, when the Fed raises rates too fast in the short term, a lot of those people that you lent the money to, you're not expecting them to give that money right back, so it takes time. These guys, they took all the money they got in the short term and just bought a whole bunch of treasuries because for some reason they thought interest rates would never go higher, which is dumb, right? And as they were starting to go higher, they should have been liquidating their treasuries and making the maturities closer and closer to their original price, but they didn't do that. So now all of a sudden they have a liquidity event. So they do have assets. Like I said, I have to do the math on it, but as far as I can tell, I don't think they need a bailout.
This just shows to me that everyone is an idiot. Because like if Silicon Valley Bank that's getting literally billions of dollars of deposits cannot realize that there's an inflation problem, that there's an interest rate hike coming, and they can't get out of these MBS, these mortgage-backed securities quick enough to the point where they have to literally collapse a company that had a $700 stock price in 2021. Like, this is insane that and I was talking to a lot of people today. Apparently, this is corporate mismanagement, right? This is one of those things where executives just really did not understand what was going on, and they fucked with a lot of people's money.
Do they have it in MBS or do they have it in treasuries? Like how much is in percentage in each one? Because that's the thing that I've been looking for, looking at FRC. I don't know if you guys saw First Republic.
Yeah.
Think about what's going on with SVB, Silicon Valley Bank, and then look at First Republic. First Republic has only $4 billion in cash. I'll bring it up. I actually have their paperwork like loaded up. Just give me a second and I'll pull it up.
Okay, this is the actual stock right now. This one collapsed. Tevis, Tannor, Riley, anything to say on FRC while Kris is bringing that up?
Yeah, so you tweeted about FRC yesterday. You said it's going to be way, way, way worse. And I just want everyone to take a deep breath. It's not going to be way, way, way worse than a stock that is no longer a tradable company anymore. Like they went full, they were $16 billion yesterday. They're zero today. They're off the books. So I don't think it'll be that much worse. In fact, I actually think that this gives some more time to FRC because they are going to see a lot of deposits from, Silicon Valley Bank actually going down. A lot of those people actually trying to get out of there and put their money somewhere else. $42 billion got out. That's going somewhere. Those companies that actually receive that is a little bit of a lifeline. It's the same thing whenever FTX went down. It actually, at first, looked to be terrible for Coinbase. And then you realize that, okay, well, those customers still want their crypto, exchanges, and that they actually just got a huge fund of new customers for that little bit.
That is true. And I think the other thing that's really interesting about this is that other banking stocks like Bank of America, JP Morgan, Wells Fargo, they were also down today. Bank of America and Wells Fargo a little bit more than JP Morgan. So the entire banking industry, at least from a stock perspective, has been affected by Silicon Valley Bank basically going down. This also was interesting because it's not like Silicon Valley Bank is like Lehman in 2008 or Goldman. It's not that. It was the 12th or 15th largest bank. So it's a big deal, especially in the startup community. But it's not like Bank of America failing.
But Amit, they were making.
Can you open slide 6?
Yeah.
Continue, Kris.
Yeah. No, JP Morgan was actually up today because they're actually one of the biggest beneficiaries. Like all of this money leaving Silicon Valley Bank is going somewhere. Like people are not just taking it, putting it under their mattresses. So right now people are saying, well, who is the best capitalized bank? Who do I know that I can get my money from, who has banking relationships? And JP Morgan has been working overtime to open accounts and get money in the door as fast as possible. So JP Morgan is actually benefiting like crazy right now. Their total assets are going to go up like crazy. So that's why you saw a lot of people buying JP Morgan, because JP Morgan is the most well-capitalized of the big banks.
Is that just due to risk aversion though? Like the money has to go somewhere. Naturally, my mind would go towards a bigger bank as opposed to like a regional bank for risk aversion purposes.
Absolutely. Like think about it this way. Of all the major banks out there right now, who do you least expect to go bankrupt based on just total assets that are out there? And it's JP Morgan, right? You wouldn't want to put it into other speculative names, even though some of the speculative names, Sofi, give like 4% interest on your money.
Okay, so here we go. Is Sofi effed? Is SoFi
Slide 2.
Is SoFi Riley? How about you? Let's get your thoughts. Is SoFi effed? What do you think?
Well, I mean, they do have some relation, but it's very, very small. And then SoFi just earlier today said that it really doesn't affect them at all.
They tweeted. They said we don't have any issues. They said stop hitting our lines. We're good. And then Noto bought 180,000 shares to kind of tell shareholders, hey, I believe in the stock. We're fine. Kris, any thoughts on Noto buying shares and basically saying we're good?
I mean, that was right now. Every single CEO on Wall Street is trying to come up ways to give confidence to its shareholders and also to its stakeholders, because the last thing you want right now is a run. Okay, SoFi right now, if let's say a third of their members said, you know what, I don't trust my money with SoFi, and they did a bank run right now, SoFi would be out of business like tomorrow morning. Why? Because most of the money that's out there is not liquid cash. It's sitting in personal loans that are out there that SoFi has lent out. Okay. That is the problem. The problem isn't these banks are healthy or not. They're healthy banks that actually make money. The problem is they cannot, when you have a bank run, you can't just solve it. You need liquid capital sitting on your balance sheet. And that, like I said, that's a vulnerability for SoFi right now. Right. So right now it's all about shoring up as much confidence as possible that, hey, we don't need the money. Hey, we can support withdrawals, and the good thing about SoFi is that they don't have concentration risk like still Silicon Valley Bank did. Silicon Valley Bank, I think, had a few thousand accounts. I think maybe like 40,000 accounts that were mainly like companies. So there's a lot of concentration there versus SoFi, who's got millions upon depositors. That's the benefit of being a bank that lends to commercial clients, is that you don't have the concentration risk that you have with dealing with like a large, like, what's the word? Like small clients, but wealthy clients.
Hey, Tannor, why is SoFi not effed?
Well, okay. So a couple different things. So I think it's not just, there's a couple of reasons why Silicon Valley Bank actually crashed. And one of them, like you said, was deposits were coming in 2020 and 2021. They were storing that money in treasuries and in very, very low paying places where they were locked up for a certain period of time. Once they actually tried to sell this, rates were so much higher, so they had to put a near 45% discount on the things that they were selling. So they got crushed just selling the stuff that they had purchased back whenever there was a massive run up. Now, if they could continue that run up with new VC money, then that would have been fine, almost like a Ponzi scheme-esque thing, but they ran out of new clients because that was just the nature of the market in venture capital. The only good startups these days are Audia, and who knows how to invest in that anymore. But whenever we're actually looking at SoFi, the difference is that, one, we don't have a lot of that old term treasuries or anything like this. We're a brand new bank, so we're just starting our portfolio right now. Secondly, no one's running from 3.75% deposits, right? This is the place people are running to. Whenever we actually look at, and I think Kris has seen this sheet, Stephen Fiorillo actually started it, and I'll put it up in the chat here in a second as I bring it up. But whenever we actually look at deposit growth, SVB was one of the lowest ones, along with like New York Bank Mellon or whatever it's called. These types of bank institutions had some of the lowest growths in deposits, like negative 12% for SVB. The opposite is happening for SoFi, where we're seeing like 500% growths just because our portfolio is that new, right? So I think it's a completely different side of the business where this couldn't really happen because we're the people are actually fleeing to, rather than even JP Morgan, Bank of America, Citigroup.
Hold on, Tannor. The reason why SoFi is growing its deposits because the attractive interest rate that SoFi is offering. They're not doing charity work, right? They're not saying, oh yeah, give us your money because you just like us. No, they're giving you a really good rate of return for your money. Now, how are they making that money? Because they have to make money to give you that good rate of return. The way they're doing it is personal loans that are out there that they're charging 11 and 12% interest on. My biggest concern with SoFi has always been around delinquencies. Now, everyone is saying, well, you know what? Delinquency rates are going to be fine because, number one, SoFi still lends to only really high FICO score individuals, which is totally cool. Like, I get the business model. Originally, they had started this to help finance people like doctors and nurses who may have been in a difficult financial position, but they're still generating a ton of income that they had to refinance their loans and all this other stuff. So that's where they started. And I still do believe if the numbers on their FICO stuff is correct, that SoFi doesn't have anything to worry about. My problem is if delinquencies go up because let's say the economy goes really bad and really sour, how much of those personal loans are they going to have to eat? The loans, the losses on those loans are going to have to eat. That's the biggest vulnerability. And then on top of it, it gets to the point where if SoFi has any trouble paying like their creditors or has to lower their interest rate just to keep their deposits in line, that means that if there's a run on SoFi, then same thing's going to happen. SoFi is going to get hit with a tremendous amount of pressure to sell those assets because they have assets, right? Think about the personal loans that they have. Those are technically assets. They're going to have to sell them. Now, the thing is, when you're in a bad place, no one is going to offer you par value for them. They're all going to say, hey, I'll buy them off your hands for 25 cents, 50 cents on the dollar, which is exactly what's happening with the treasury.
So the way SoFi collapses on this or any type of neobank is not because of Silicon Valley Bank collapsing writ large and that having a ripple effect. Rather is if the ripple effect of SIVB collapsing creates an economic meltdown, not Lehman in 2008, but if it does something similar to that, then delinquencies will happen for those personal loans that SoFi has assets for. And that would cause a bank run on SoFi because they can't afford to pay the interest rates. But barring some major economic catastrophe because of this event, which I think we can all agree, I don't know if this is a catalyst for like a Lehman in 2008 type of Great Recession crisis, SoFi should be fine because delinquencies shouldn't happen.
So maybe I
sorry,
can add just yeah, go ahead, Tannor.
I was just going to say, I also think that eventually, I think the problem is that sometimes with Kris, what I find is like, you can't argue if you just don't believe in the numbers. So I personally do believe in what SoFi is putting out. And then also, whenever you also, look at the rating agencies that are also rating the loans on their balance sheets, it was completely different between SVB and SoFi. SoFi has been rating their ABS markets that they're actually putting out their loans for sale, which is our biggest portion of our actual balance sheet.
And how much do they have to over collateralize to get that A rating?
Yeah, but then so that's a completely different idea. So the idea that it would be AAA rated would mean that we would have the lowest amount of actual discount versus anything else. Like B rated, like triple B loans would have the highest amount of discount. AAA would have much less.
Well,
right?
all I'm saying is there's two things about their FICO scores that that would concern me. All right. Number one, when these loans are issued, that's when your FICO score readings are, because that's what they say at the time of origination. This is the FICO score of the individual, right? Let's say I make $150,000. I fit right into SoFi's profile. I'm good. I pay all my money on time. And then I have a credit event. Let's say I lose my job, right? Do you think my FICO scores matters at that point, whether I can pay that loan back or not?
Well, this matters though if you lose your job, which means the economy has to crash for massive.
And that's right? The point. That's the point that I'm trying to make, that, you know what, we are going to see in the next year, 2 years, how strong the borrowers of SoFi really are. Anyone who took out a personal loan, we'll see. Like I said, I'm not saying that it's definitely going to happen, but if delinquency rates start to go up because people lose their jobs, that's what happens during a recession.
So, okay, I think
sorry, I'm sorry, Tevis, but like, I just don't want you to say something like that. And then okay, so really quick. A credit score only means something because of the history that they have with those numbers. So if the same numbers are considered high rating or super prime numbers for the 2008 crisis, and then Chris Hager has already showed off that chart, so I don't want to show that again. But the idea that some people are getting loans and then at the time that they actually got that loan, they had a high rating and then it recently dropped, is the same thing that would have happened in 2008, right? It's just an arbitrary number. We understand that it can fluctuate, but that's still considered very, good risk to have taken on. So I don't think that it changes at all. There's not a particularly or sign that the people that go with SoFi end up quitting their jobs regularly than any other person that might have a 760 plus FICO score. So you kind of have to look at it the same way that JP Morgan has clients that have over 760 is the same way that SoFi has a client that's 760. Like the delinquencies could stay the same.
I wish The Weeknd named his album FICO Score live at SoFi Stadium 160 and above. That would have been a dope album.
Yeah.
Okay, Kris, go ahead.
No, I was just going to say, I think we're looking at 2008 and saying, well, you know what, 2008 was fine, so this time is going to be fine also. I don't necessarily think that. Like 2008, Silicon Valley Bank survived. This time they didn't, right? You can't look at the past and say, well, you know what, they did it last time, so this time is going to be just fine. You know, there's a lot of changes. There's a lot of differences between 2008 and now. A lot of people that were underwater in their mortgages and everything else, that was 2008. Right now, their actual assets that people have are really there. There isn't a what's the word, like a subprime lending event like in the past. In 2008, you had a subprime lending event where people were just putting down, oh, I make $80,000 a year, give me a loan, and people were just getting it. There was no background checks and everything else. This time around, that's not there. But that's not to say that there aren't other factors that are out there that we may not necessarily be seeing. Like, here's the thing:
what about things like capital ratios and these sorts of things that were totally not monitored back in 2008? Like where banks can hold at least 2%, high quality capital in order to, facilitate their loans. Now you look at SoFi and they have over 14% on their books to actually make sure that their personal loans are actually being facilitated. And by the way, the Fed, the OCC, the SEC all have looked at our charts and said, even though you're running personal loans, we'll still keep the minimum at 7%. That's lower than lending clubs, right? So why is it that we get an advantage over Lending Club or some of these other companies still with very similar products, but we're able to hold less on our loans to actually, have a backdrop, and then still we hold more than double that amount? Like, I don't know how SoFi could show you any more than that to say, hey, like, we are playing it safe. We're actually not doing dirty work. Like, of course, we're still growing. We just got a bank. So the amount of loans are going to skyrocket and the delinquencies are going to skyrocket, but we are growing at such a high rate as well.
Yeah, like I said, I'd keep an eye on the delinquency rates. I'm definitely not someone that's going to be an expert in this unless I had like a spreadsheet with all the individuals' names on it, their FICO scores next to it, and then seeing who they are and figuring out, did they lose their job? Did they have their job? Do they, did they change anything in their life? Like, it's not as simple as it was back in 2008 where Burry was able to pull up a bunch of mortgages and then look up the price of the homes that were dropping at the time. Like, that was a whole different story. I think this is going to be something that's been left to be seen. But I'll tell you right now, in a negative economic downturn, SoFi would probably be unlike the last of my list in terms of companies that are going to do well. All right. That's all. And right now they're not profitable. The other things, that's the other factor too, right? There are banks right now that are significantly more profitable that are still offering really good rates of return.
They're not net gap profitable, but they are cash, like they're not cash burning. We are making money every quarter.
Yeah, guys, I don't know if I can jump in here.
Yeah, just go ahead.
I think we're just conflating a bunch of things. Like, this started out as an SVB thing that can ripple out.
And I want to go back to that.
Yeah, and okay, so a couple of things. I think when dollars shift around in these types of events, there's two reasons that I can think of. One is for opportunity, in which case SoFi's yield would be something that's attractive to people shifting their dollars around. And the other one is fear. Can this bank, remain solvent during tough economic times? And I think that for that, how I'm justifying it in my mind is that I understand delinquency rates can rise, despite, in the Q4 earnings, they basically said it's at 2019 levels, like pre-pandemic levels. It can rise, absolutely. But as delinquency rates rise, they rise across the board and affect every single financial institution. And if I had to make a list of all the financial institutions and put SoFi on that list and, towards the most risky and the safest, with SoFi's metrics where they are in terms of their ratios, I would put them towards the more safe aspect, especially considering that their cohort is generally more affluent people that, again, operating from a place of logic, would have more of a buffer financially when times are tough to sustain themselves until they can bounce back with another job. And so I think that if we think of SVB, then I'm viewing it almost similar to FTX to say, what were all of the institutions that were connected to this? Those are the next at risk. But right now, what we're talking about is we're talking about a full economic meltdown that raises the tide of delinquencies across the board for all financial institutions. And just fundamentally, I think that it's opportunity versus risk. It's an attractive return for me to put my money in a safe place, and it's, can this place stay solvent? And I just think that for those reasons that I laid out, SoFi is one of the better options from both an opportunity and a risk perspective.
Going back to Silicon Valley Bank, because that's really what I think is a more fun topic in my opinion.
It's a good topic, but I think everyone in the chat wanted to know the implications for SoFi. So we got the bull side from Tannor in terms of, it's going to be pretty okay. And we got the bear side from Kris. If this caused a real economic crisis, then it would be bad. So
now we're one thing. Can you put up the comment that Eric put up real quick? Because I think that's a very interesting thing. He said, for example, if SoFi had a high concentration of tech workers where their job market has been hit harder than other industries. So this is the kind of theses that would typically get brought up, right? Who are high income workers? Well, tech workers. Where are they? In California. A lot of California tech workers are there. SoFi, I guess, has a large market of people from California. If those tech workers get laid off, if all of these founders, look at right now, SVB, right? They pretty much had a ton of people who are in the founding stages of tech, right? So if they lose out, now they can't pay their employees. Their employees can't make their personal loan payments. You've got higher delinquencies. All I'm saying is watch those delinquencies. The delinquencies are going to be the canary in the coal mine in terms of where SoFi is headed. That's all I'm saying. I'm not saying that they don't have enough capital. All I'm saying is in a hard economic time, you're going to see who's swimming with no pants on. That's all.
To Chris's point, if you bring up slide 4, which is actually kind of interesting, nearly half of all U.S. venture capital-backed startups were involved with the Silicon Valley Bank, per Bloomberg.
Not mine. Good old Bank of America.
88% of Forbes 2022 next billion startups are SVB clients, which is insane. And
Roku had about $478 million of their of exposure to SVB, and Kris, you'll get a kink out of this. Ginkgo had $74 million in SVB.
That's great. And then Circle at the bottom of this little table here, the 25% of their cash reserves were in SVB, and they're the ones controlling USDC, which is the stable coin for. I don't know any of the implications of what this means at all, but this feels like a black swan for tech, out of nowhere.
Well, I think
of course it is.
When we talk about the actual companies that were linked with SVB, I think one of the interesting points was the FDIC insurance, right? I was reading somewhere that FDIC, one reporting said as much as 90% of all deposits in SVB didn't meet, were higher than what the FDIC cap was of 250,000, meaning that, well, it might be less than 90% in total. That number will be seen, but a very, very large percentage won't be insured. So a lot of these companies that are linked with SVB, obviously that's wildly negative, Riley, right?
So Tevis, they'll eventually get paid. Yeah, they're definitely going to get their money back. The problem is liquidity. The FDIC is going to take all the assets, try to sell them slowly, and give the money back to the creditors. Because now all these people end up on something called a creditor committee, and they're all going to get their money. But the question is, you don't have that money to do other things with. Let's say right now you were about to invest in a building. You were investing in new software. You're not going to do that. You were planning on hiring people. You can't do that. As a founder, you're pretty much stuck at the FDIC level. It's up right now. The hero of the story is going to be the FDIC and how quickly they move to unfreeze that money and get it back to these other companies so that they can keep their payrolls running. Because if you had significant amount of money in the bank, right now, if Amit was running his startup, all his money was in SVB. If SVB is right now taken over by FDIC, Amit will get his money, but they'll get it slowly. Now, Amit still has to pay all his bills. He has to pay his AWS. He has to pay his employees. He has to pay all this other stuff. And that's where the contagion rises. That's why I put out a tweet earlier today. I said, I wonder what the exposure to these big tech companies is going to be. Because remember, they all provide services to the smaller tech companies that are still in the founding stages, right?
That was a good point that you brought up, Kris. And then Tannor, we'll get to you. And let's get your take on this, Tannor, as well. This idea that Amazon, Google, Snowflake, they all provide a ton of services to smaller startups, or even, Series C, Series D startups. And if those companies can't make payroll, much less pay for those bills, that might have an impact on earnings, which might be kind of a bit of a catalyst going into Q1 earnings for 2023 for a bad earnings report, at least, not a good one. Tannor, you can speak on that, and then you can go back to the point on SVB.
Yeah, I mean, it is crazy, right? Even though their market cap was quite low, the assets under management here was like 200 something billion. It was the second biggest bank to fail since 2008. I think it was Washington Mutual is what I think I read was the largest bank failure in the United States in terms of assets under management. But whenever we're actually looking at that, you're talking about VCs that are collecting all this money that is being hosted at SVB. They're taking this from, LPs that are also giving this money. They're distributing it to Adia, who's also being told that, keep it in SVB. And then it's this big string of, okay, now no one's allowed to take their money out of this account. You'll get $250,000 by Monday morning. Okay. And then, what does Roku do with $250,000? You know what I mean? Pay an engineer, a single one. You know what I mean? So then we have to actually sell it all out. Hopefully, like Kris said, they'll all get their money. I mean, hopefully, all the goodwill and all of this stuff in terms of the actual name brand of the company are completely gone, right? Even though they kicked Sam Bankman-Fried out of FTX and then they go, okay, well, the withdrawals are back. No one's using that company again. You know what I mean? The actual name brand of Silicon Valley Bank is done for. So there are a lot of things that are being weighed that will be gone forever.
Can you explain I'm sorry. Could you explain? So, as I understand it, there's only a certain amount that's FDIC insured, but you're saying they're going to get all their money back. Is that because, or can you just explain that?
They're a chop shop, right? They're going to take this whole company, see what they own, and sell it off to the highest bidder via auction, and then they're going to pay out like a dividend the proceeds back to all the.
But it definitely won't be enough to cover everything, right? Like they only.
Well, that's to be left to be seen, right? The problem is
we don't know
if you take all their money and if you take all their assets, right, which is essentially just treasuries, and you put it into the market right now and says, okay, whoever wants to buy it, dude. Every buyer is going to say, I want a 50% discount because you have such a huge volume. That's the problem. Now, here's the thing: if they sell it, let's say 5% here, a few percentage here, a few percentage here, then they'll actually get a fair value on the asset itself. If you are trying to sell a whole bunch of assets in a very tight market where right now a lot of people aren't exactly happy with the cash that they're going to ask for huge discounts. And those huge discounts are going to basically mean that all the creditors may not get their full value. That's the other issue also. So, it all comes down to the total, how the FDIC is going to unwind all of these assets. Because if they do it too quickly and they have to sell everything off, that means that all these people are probably going to get like 50 cents on the dollar. If they do it in a slow, gradual pace, they may end up surviving and most of their creditors end up getting majority of their money back. I believe that the ideal scenario here would have been someone like JP Morgan buying the company out, using its depositor cash that they have on the side to make sure that there's enough liquidity so that all these guys are made whole.
So why didn't JP Morgan buy them out this morning? Why?
Because JP Morgan probably asked for 5 cents. They probably asked for 5 cents on the dollar, dude. That's what I would have done if I was Jamie Dimon. I would have said, no, I'll give you 2 pennies to rub your hand with.
Why would JP Morgan buy them out when they're the main beneficiary of all this money that's flowing out?
That's the other thing. Great point, Tevis. Why would you end up doing that? Because all these guys are coming to you as clients anyway. It's about the franchise. It's about the franchise.
How in
You
the
know what,
hell
the
is
banking
Roku
world-
going to get $487
They're
million
not.
back?
They might get 20% of that. Maybe.
That's-
Like
That's insane.
so. Kathy's in some issue with Okay, Tanner, go ahead.
No, I was just gonna say, I think like the finance world is such a funny one, right? Like they're all of these banks are sharks, and these sharks are friends until one of these sharks starts looking like shrimp or something, you know, and then they literally attack them. It's kind of funny how it works, and I think JP Morgan already came out with a statement saying we're not touching anything, we're not buying, but that's a lie. You know what that means? That just means they didn't get a good enough price. Like,
Well,
they're
Tanner,
absolutely down.
Tom made a really good point that I didn't think about until he posted it, which was there could be antitrust. JP Morgan's already the freaking large goddamn bank
That's
on the
true.
market.
Yeah.
You know, you're not trying to make banks even bigger, you know.
Yeah, I don't know how antitrust even works with banks, so I wouldn't know. I wouldn't know how that actually works. But you know, do you think that they're running into a? Yeah, because I don't think any of us are going to know. Maybe you guys do know a lot about antitrust, but whenever it comes to finances, is it broken down into a category? Like, anyway, I don't want to get into that because I don't think any of us know enough about that. But I just think they already tried a sale of $21 billion, and that alone, they already took massive losses on it. And they did that before people even knew that there was a panic. You know what I mean? They had a small little fire sale whenever, you know, people didn't even really know that there was a run. Now,
Right.
supposedly, things are coming out. Founders Fund and Bill Ackman and a lot of these guys, I guess, already quite knew, maybe 6 months in advance, that they were talking to Goldman Sachs and JP Morgan. And there was a little bit of talk that they were in some hot water.
Oh, so you think
so-
SVB knew 6 months ago they were
Okay,
about to go under?
hold on. Can we please, let me adjust my mic for this. Can we please talk about the fucking elephant in the room, which is that the executives sold
yes, we gotta
stock
talk about this.
days
Yep.
before all of this happened?
Yeah, let me bring that up. So go ahead, you can introduce it, Tevis.
Yeah, I mean, look, there's been executive stock sales this year in large amounts, but I think it was the CEO, Tanner, keep me honest, but the CEO and another C-suite, maybe the COO, both of them sold huge chunks just a couple of days before all of this went down. And yeah, it is. I think
And then
Tanner
they
tweeted
said
about
to
it.
keep calm to their investors days after they sold everything.
Yeah, this
they're
is
straight going to prison.
incredible. I mean, this is so the CEO since December 28th, Gregory Becker sold $3.578 million of share. Look at these share prices he's selling at 287, 300. So the February 27th, he sold 12,451 shares at $287. Today, the stock is zero. Like, he sold at 287 times that. And this was today's March 10th. This was 2 weeks. 2 weeks before this all went to shit. You can't tell me you didn't know 2 weeks ago that you guys were in deep shit. So do you think he gets busted on insider selling? Do you think the courts go after him on this one?
1,000%. He used
He has enough
non-public information
money to buy a lawyer.
Yeah, he used non-public information to make a private sale.
What if he just says, "Oh, I felt like selling. Like I woke up and I kind of just felt like."
Then he would need a long track record of doing very similar activity.
Man, nothing's gonna happen. They'll just slap on the wrist. All these guys have enough money and lawyers to just take a slap on the wrist, move on. They're like, screw it. If you know, yeah.
They'll get a fine that's a fraction of the sale proceeds, and there we go.
Whoever this the owner of that $3-point-something million worth of shares that they sold to on public markets, you know, I'm sure wants a little bit of ramification whenever the person that you're buying from is, you know, has completely different information than you. Like
maybe there could be a clawback of that, and maybe the government's like, "Hey, because that's $4 million. I mean, it's not a lot of money, but Roku could use that $4 million more than Gregory Becker probably."
Right? Yeah, the person that bought those shares, I don't know who, the John Smith on the other end of that deal is down $4 million. They're not down 60% of it. They're not down 50%. They're down to zero. You know what I mean? If that is a regular, you know, retail consumer buying and selling stocks, that is That's insider trading.
Dude,
That's
no,
why we
no
have those
one,
laws.
no one cares about the retail trader. Okay, it's nothing that anyone's going to do anything about. Just retail traders are going to get waffled on this. So hey, do me a favor, share the screen real quick. I just want to show you guys what a fire sale would look like for these guys if they're trying to unload stuff.
Oh, please do not play that. Please do
Fantastic
not play
movie,
that.
by the way.
Give me
You guys
Wait,
are playing
what?
a literal movie on a live stream. Do not play this.
It's okay. We got a $20 super chat, so that'll cover the
Okay,
the
okay,
$2
cool.
of ad rev.
We got a community guideline strike.
Hey, it's Will Emerson.
William, how are you?
I'm all right. How's the trouble and strife?
Busting my ass as always.
You see, that's what I tried to tell you, John. Why do you think I'm single?
I know you did. What can I do for you?
Listen, I just got the tap on my shoulder, and we've got some risk over here that we need to move. So today it looks like my loss is your gain.
What kind of size are we talking?
Should be on your screen. I just sent it.
Jesus, where does this land?
96 on the dollar.
91,
All three, and we're done at 94.
93 and a half.
Done.
Trading.
Hello, gorgeous.
Will, what's happening over there?
Well, today's moving day.
What are you guys so worked up about?
You think they tell me anything? All I know is that today my loss is your gain. Now you're a friendly, so I'll come to you first. I got 270 mil, 15 a year, paying out a point and a half above par.
Where's it from?
Where's it from? Do you care?
No, not really. Now, where's the trade? I'm hearing things
Alexis,
and you guys are
I'm
scaring
only
me.
sharing this with you right now. 85.
Done.
Don't you?
It's Will Emerson.
Fuck you, you limey bastard.
Are you still angry about it?
Word's out. I'm hanging up now. Meryl,
Lawrence,
what the fuck are you guys doing over there?
just a little spring cleaning.
That is not what I'm hearing.
All right, Lawrence, are you a buyer?
I'm not sure anymore. Where at?
Well, it sounds like I should be asking you where.
What are we talking about here?
375 mil, 30 year mixed.
Fuck me.
Are you with me on this?
63 cents.
Oh, fuck you, I'm hanging up.
63.
Let me call my man here. I'll come back to you in 5.
Maybe 55 and 5.
Well, all right then. Stay on the line. Sam, pick up the phone. Sam, get on the line.
Yeah.
I got Lawrence and Merrill.
Where are we?
63 cents.
Jesus. On what?
375 mixed 30.
Get him to 65 and hit it.
Are you fucking kidding me? What is that? That's a $131 million loss on a single trade.
I understand. Hit it.
Hey, Lawrence, we're Philip Kill at 65.
It's filled.
So
You're on mute.
just
You're
so
on
you
mute.
guys are aware, a day ago, halfway through this event, Moodys had actually downgraded them and put a 45 or an assumed 45% discount on their bonds. So exact same thing of what you're seeing there. $100 worth of trading was selling for $55. So even worse than what the margin call movie had even depicted. Oh my God, 63 cents on the dollar. No, try 55. So this absolutely just happened yesterday.
Yeah. So it's crazy because this is the kind of stuff that happens in the background that not a lot of people really know about. So it's nuts to see, but believe it or not, that scene actually happened in 2008 with Goldman Sachs. Goldman Sachs knew that they had all these MBS products that were going to pretty much go belly up. They were selling them early. They're like, no, you know what? If we have to take a loss on it, we'll take a loss on it. Now think about all the guys, the bond guys that had originally bought it at 100 and now had to sell it at 55 cents on the dollar. That's a huge loss, but guess what? At least it's actually now worth 55 cents on the dollar that you got. Anyone who's a bondholder in SVB right now, they're probably going to get zero.
Yeah, and I mean, you talk about like fiduciary responsibility, and then you're like selling products that you know are crap. And I mean, if you've seen the movie, one of the lines that he was saying was, "This is going to absolutely kill our reputation. Like nobody is ever going to buy stuff from us again." And I mean, it's exactly the same thing with a lot of these banks because they have like such a long tenure, and then it's just do anything you can to survive. You know, like cut off the arm to save the body type of thing.
Let me put this question out there. I've heard some tweets that the United States gave $100 billion to Ukraine. So if we care that much about Ukraine, why don't we care that much about our beautiful U.S. tech startups? Is there any thought to the U.S. kind of coming in and helping?
Are we talking about
Ukraine?
Yeah, I mean, look, how much do we want to have a safety net for these types of things that it's just like you got yourself into this position by having reckless guidelines and going risk on a lot of things. The government is not supposed to be the piggy bank or the safety net that once you screw it up, taxpayers are going to foot the bill, and that's what happened multiple times in the past. But in normal functioning markets like these things, you should be allowed to let these things go out of the system. The problem is that so many of these things are so intertwined that they just bring everything down, and then the government is forced to step in because this is how the meltdowns start.
It's absolutely crazy. I just wanted to add a little bit more context for people to really understand, the kind of crap storm that SVB got themselves in. Is that one? Obviously, we covered the deposits, what they were doing with those deposits, and then what happens whenever the inflows just completely dry up. In the other breath, SVB also had a venture capital investment arm of their own, where they had like 800 plus investments into other, VC companies, which were also not doing good in private markets. So they had unrealized losses throughout that. So whenever they were going for this fire sale, whenever they were looking at their private investment arm, whenever they were looking at their actual treasuries, they had nothing good to sell. And probably, and I haven't looked this far back, I bet 6 to 9 months ago, they probably did have a couple good assets, and they had sold those off already, hoping to extend their runway. The problem is that once we actually hear about this and these stories go mainstream, these problems that have been brewing for 18 months behind closed doors, ends an entire banking company in 48 hours. It's unbelievable.
Yeah, and a counterparty risk too, right? That's the other thing, because there's a lot of innocent companies that had nothing to do with this that are going to be negatively impacted. Remember, what happens is when an atomic bomb drops, it's not just the center point where the bomb hits, it's all the surrounding stuff around it that's also going to get hit also. So right now, if you look at California and the region that they're in, dude, if all these tech workers start losing their jobs, these founders start losing their hobbies, their money, that means that, guess what? Their local real estate market is going to start collapsing. The local commercial real estate market is another area that's actually another problematic area. I sent you, Amit, some article about that commercial mortgages right now are kind of teetering because occupancy rates are not that great right now. So this is just one more thing that could lead to more dire economic consequences. But I just want to say one thing. This is not unheard of. Like, this is how the market cycle works. There are times where things are really good, and then we get a little too punch drunk, thinking that everything is going to be normal like this forever. And then guess what? Once the punch bowl is taken away, everyone is like, it wakes up from their high and just like, oh my God, how did this happen? But I will say this. I don't know if you guys are looking around for opportunities, because that's what I'm doing right now. I'm looking for companies that have well-structured balance sheets that can survive this and end up coming out really strong on the other side of it.
This is a video right here of people actually outside of the bank trying to get their money.
You know what?
Go ahead, Chris.
I would say I have no sympathy whatsoever for any of those founders that kept all their money in one bank, and basically there was none whatsoever.
So
none whatsoever.
Amit has everything in Bank of America, and he was talking shit about Bank of America 2 pods ago. So
when did I talk shit about Bank of America?
I can pull the clip if you want.
I said their app sucks compared to Sofi, obviously. But see, like, Chris, if Bank of America went under, that would be like, we're done, right? Like the economy's done, right? But Silicon Valley Bank is not Bank of America.
Right. But regionally, it is definitely going to be a problem. Like for a lot of VCs and founders and everything else in both the tech, and this is the hard lesson that we all need to learn and take. All right. All these founders from now on will second guess anytime that they put their money anywhere where they're putting it. They're not going to be stupid about putting all their eggs in one basket. Because if you were dumb enough to do that, you deserve everything that's coming your way. I'm sorry to say this.
Yeah, and the main reasons they invest in Silicon Valley Bank is because of the favorable loans they give to founders, right? That's the reason that bank is so successful, or was. So
yeah, they had a perfect niche, being they offered amazing deals that were structured to be in the VC area.
Yeah.
It's just whenever they had such an insane run up in VC, and then that came to an end, we saw the strongest drop off that we've ever seen. So like Kris said, this was almost like a leveraged bet, right? If VC continued to climb, this would have been looked at as one of the best performing stocks ever. I mean, JP Morgan, even, while this was happening a month or two before, they gave this stock an overweight rating of $375. A month later, the stock is worth, well, actually this morning it was worth 10% of that. Today it's worth 0% of that. But yeah.
So James McGuire says the problem with many different banks, how do you need to keep your bank safe, blah, 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 blah. My thing is, guess what? Keep some of it in highly capitalized banks that are there. If you're a founder and you're putting your money in a bank that's very speculative, that's your problem. You made a bet with a bank. The bank failed. You lost a bet. Why is it the government and the taxpayer's responsibility to bail these people out? Yeah. Why is it always the taxpayer that ends up having to deal with this?
It's a really good point.
The problem is the reason why they're the bailout people is because they are unsuspectedly and unknowingly going to be dragged into being a victim of this actual bank collapse. Like that's the problem, is that there's so many ties to these banks that you probably don't even know that if you are an LP, for example, that the venture capital company that you had trusted is making sure that the businesses that they're investing with had that money in this bank. And so all their money is tied up. They can't pay employees. Payroll comes around and the businesses, like multiples, get chopped by 75%. And then that gets sent back over to the LPs. And then obviously they lose a ton of money. And they had no idea that this was happening.
And this is a real quick, this is a good point that Tanner is making. I just want to harp on this for a second. Silicon Valley is unique to America. It's a state of mind. And it's a state of mind that in America, you can try to do something that likely is going to fail. And you will have the capital in order to go build that thing. Like Facebook, Amazon. Like Facebook doesn't happen unless Peter Thiel gives Mark Zuckerberg $500K when he's a 19-year-old kid who's socially awkward. But like the culture of America is that LPs, limited partners, the Harvards, the Stanfords, these endowments of the world, they will take billions of dollars, give them to people like Andreessen Horowitz, Sequoia, General Catalyst, Mayfield Fund. And then those general partners will tell those LPs, hey, we're going to take your $2 billion and you give us 10 years and we'll turn it into $6 billion, which is way better than what you would have got investing in public equities, because we will invest 95% of it into what we think is going to be the next Google. All of them will fail, and we will somehow find you the next Uber, and we will make you back 10,000 times your money. That is unique to America. And the bank that was supporting that unique, innovative, like amazing culture just collapsed. And so that's why this really does suck, because again, that goes back to the LPs, and they're like, well, wait a second, why should we give you our money now if you can't promise us a return?
Here's a question that it's going to be controversial, but why not, right? So one of the things that I'm hearing is that Silicon Valley Bank was very high on initiatives around diversity and inclusion and equity and all that stuff. Where does diversity, equity, and inclusion play into this role? And where did you sacrifice competence to be more diverse? That's the question that I think a lot of people, that's my brain right now. It's like, oh, I wonder if they said, you know what, we're not going to turn away some competent people, but we want to be more diverse. So we're going to hire the diversity hire as opposed to hiring someone.
And you think that those diversity hires might have made the mismanagement to invest in mortgage-backed securities?
Who knows? Who knows?
Yeah. So that's the talking question. About mismanagement.
Let me just add one little point, Riley. Because we were talking about why should bailouts happen, right? And I think, first of all, let me just say that I'm not for bailouts. I think that these institutions being allowed to fail is a feature built into the system and not a bug. But the case for bailouts is that banks, from a leverage ratio perspective and a liquidity perspective, can crank up the multiples by which they can command liquidity much more than individuals can as a result of just regulators in general. And so it's just like, well, why are you allowing for banks to take these risky positions if you're a regulator? And then when they fail, you're the one that has to bail them out, right? And I understand why that happens because it's just more profitable that way. But I think that, like, from a regulatory perspective, if you can allow a bank to go 50x, 100x, then that's just a recipe for disaster waiting to happen. And that would be a case that I could see for a bailout. Is this the regulators basically made the rules? Don't hate the bank for taking advantage of them. I don't know. Maybe that's a simplistic way of viewing it.
But let's also understand that, like, most times a bailout is not, a free check that ends up going to these businesses. I mean, the government makes their money, right? They put it in offers with crazy amounts of equity, loans most of the times. They always structure it in ways, I don't know what the returns would be on a lot of these things, but they're extremely, extremely aggressive. And even you're seeing that already, the amount of loan sharks that are coming out of the water to these, small venture companies where they're saying, hey, you got to pay your employees for next week. I'll give you the 10 mil that you need, and, throwing 20-25% interest rates on this just because founders want to keep their company alive. And
guys,
right?
you're dancing around the diversity question. What do you guys think? Do you think that diversity?
I'm not answering that.
I don't think that's a reason. It's an interesting point. I don't think diversity is the reason the bank collapsed.
I just see too many people
I'm
saying,
here to talk about the numbers, man.
Yeah, I just see too many times where it's like, go woke, go broke. And I'm starting, but I don't want to say I'm starting to believe it, but part of me is like, I wonder if they made hiring decisions based on age,
bro,
you
know
race
why
and gender. Yeah.
You know why you're
Go
wrong,
ahead.
Kris, on this? Silicon Valley, so less than 1% of funding in 2021, in the greatest year of funding, went to women and minorities. So like white guys still get them. It's just like empirical. That's not me ideologically saying that.
You're talking about the companies that got it. I'm saying the
so that's my
leadership.
point. If
If
Silicon Valley is funding pretty much white men, right? This is don't get offended if you're a white guy. These are the numbers. Why would the Silicon Valley Bank be up in arms around? Like, they probably have a ton of white guys making these decisions. I'd imagine at least these decisions about allocating capital. I don't think they have.
Banks are different than tech companies, though. And that's mainly my question. You guys think it's a management issue. The whole reason I think about this whole SoFi weekly thing and why I'm kind of a bull in SoFi, not that they're the solution to everything, but banking is inherently flawed by like the way that it's managed. So do you think some of this could have been mitigated if I mean, like, you guys are Palantir bulls and you think that a lot of like software now is kind of redundant and weak and doesn't actually provide a lot of value compared to Palantir and what they're trying to do.
If you're asking if Palantir could have solved this, the answer is
no. I'm saying, like, do you think that this situation could have been avoided if
they had Palantir? Yes.
Or if there was some sort of
SoFi had business accounts.
Could this
no,
been
because
solved
I
by
wouldn't put
software?
my money. I wouldn't put my startup's capital in SoFi's business account. Not after this shit. This is like SoFi could introduce business accounts tomorrow. I would be scared as hell to put it in SoFi.
Yeah.
Like, I don't know.
That's true with any disaster, right? Everyone goes to the safest option. I mean, everyone, whenever FTX went down, it was just even crypto-only maximalists sold all their altcoins, just put it in Bitcoin. I think JP Morgan, Bank of America are going to be the biggest, beneficiaries of this, just because people need to run to some safety net, and they're not going to store it under their couch cushions, like Kris said. And so I do think the big banks will benefit in the short term, but I do think that there will be a return to a lot of the normal banking procedures that people go back to all the time.
Okay, so here's the next question for the chat. And shout out to 301 people being here. This is the first time we've had 300 in the chat. So big momentous occasion for us. Everyone's links are in the description. YouTube, please follow on Twitter. And I think the reason we got 300 is because Kris is in the thumbnail. So that's the reason we got 300. Would crypto have solved all of this? There were some people like Balaji tweeting, he's a sort of crypto masculist, basically saying that the reason this is messed up is not because of corporate mismanagement. It's because like we don't have real financial decentralization. Tevis, what do you think? Would crypto would have solved?
Did you see Elon's tweet? It was super recent. It was a meme. Just pull it up because I think that it's relevant and it's funny. And honestly, it's like the seesaw that always goes on one hand or the other, depending on what the crisis du jour is. So I'll just wait for you to pull that up. So you can narrate this one.
So there's two buttons. One says crypto is a scam, keep money in banks. The other one says banks are a scam, keep money in crypto. And then there's a guy sweating. That's yeah.
So that's what I think.
Well, see, but some banks are a scam, not a scam, but like they're a little bit unsafe at Silicon Valley. But JP Morgan, Bank of America, they're not having these issues. So to me, I'm like, I don't think crypto would have solved this.
This is just like we're seeing, and I feel like this happens all the time. Did my mics just cut out, by the way?
No, you're good. You're good. You're good.
You're good.
Okay. I heard something. I don't know if you guys heard that. I think maybe it's low battery. Anyway, like we saw the highest, such a momentous uprise in VC, and then we saw the most highest and largest uprise in interest rates. And now this will happen again in another industry, but it's just a historical event that I might even go as far as to say that there's just no way they could have modeled for this. It's extreme, never before seen in two different areas that made this large bank fail.
No, Tanner. If they had Palantir, this definitely would not have happened. Palantir could have modeled this out and actually done some predictive analysis to say, hey, look, if interest rates go like this, this is our total risk, this is our exposure. But guess what? You didn't have Palantir, so
they probably didn't have any business intelligence tool as advanced as something like that.
No, they probably did. I mean, I doubt that anyone.
They might have had Snowflake. That's why.
Depending on how big this is, how big this black swan is for a lot of tech companies, do you think there's going to be like some sort of fintech like renaissance or something? Like, because this is hitting directly home for like just tech companies, and I feel like
I cannot believe you cut me off to fucking say that. What the hell are you talking about?
I didn't know I cut you off. Sorry.
Okay, Tanner, say what you're gonna say. Then answer Riley's question.
No.
Your mic is pretty bad this time.
Yeah, I'm sorry.
Tanner, you go to the States once and you become so much more aggressive on these pods.
I know.
Yeah, bro, you're a Canadian. You're supposed to be nice. You get
No,
the
it's a
Florida.
Florida
Tanner, you're a Canadian? I didn't know that. I didn't know you were a Canadian.
Yeah, my friend, in Toronto.
You-
No,
you
go
have-
ahead,
These guys,
Riley.
bro, Kris, these guys are such fucking frauds. They don't even have SoFi accounts. Talking about they're on a SoFi.
Whoa, y'all don't have SoFi
Nope,
accounts?
they're in Canada.
Wait, Kris,
Oh,
you don't have a
God.
Palantir account?
What are you talking about? I have Palantir certification, bro.
Kris actually literally just got his Palantir certificate. He literally just got it.
Oh, okay, got you. Yeah, no, I'm a Google employee too because I got the free online course. Okay, listen.
I'll be
no,
honest,
hold on.
that was a good one.
There are people on LinkedIn that will say they went to Harvard. I go down. It's like Harvard, like learning how to manage certificate. Like I'm just like, all right, this is like saying you're a director of operations at Google, and it says you're a shareholder of Google because you own like 5 shares or whatever. It's interesting.
I was just gonna say though, Peter Thiel's Founders Fund used SVB. Okay, they were a large proponent for SVB. So who could have sat in a closer chair to SVB than Peter Thiel's own Palantir founder? Okay, they obviously didn't want their product. That's all I'm gonna say. That's my contribution to the SVB thing.
That's a lazy take. I mean, maybe Palantir
They had a salesman right in the
Sorry,
chair.
did we bleed into Palantir Weekly? What the fuck's going on here?
Kris, is it Palantir
No, we
Weekly?
bled
now?
into
Is it
FinTech
Palantir
Weekly. This is a FinTech podcast.
Now,
We're talking about
granted, look at this.
technology.
Morgan Stanley uses Palantir, so it's not like banks don't use
Really?
it. Yes, Morgan Stanley's been big on Palantir for a while. So
Maybe they were too woke to use Palantir because they're the SoFi. I mean, not
that's
SoFi,
where
Yeah.
your DEI point makes a lot of sense because Palantir is not seen as a company that's friendly with diversity and equity and all that stuff. Yeah,
That's right.
Chris, stop trying to come back to the diversity point, man. You come on one episode and you're gonna try to
I
get us
just-
all
I
canceled.
love- Dude, I love watching you guys. It's so sad that we can't even talk about this because it's like, oh well, I'm white, so I need to just shut up and not talk.
Tevis,
about
we
it.
need
Like,
your perspective as a white
Yeah.
man. Do you think this is what caused everything?
Look, man, I think that at a super high level, I think they either know how to fix it. So let's take the Palantir example, right? They either implement Palantir and don't pay attention to what it's saying or the signals that are flashing, or they don't implement Palantir at all because they don't recognize the problem. Both of those are equally bad.
Perfect dodge the answer,
Do
politician.
you think they did not implement Palantir because of DEI initiatives? That is the question. It could be because Palantir has a hard time. I'm saying this as a guy who loves Palantir. They have a hard time selling because the freaking NHS is about to get rid of their contract because they're afraid of.
I think what it is, it's a mindset, right? Where you have competent products and competent people that now you have to take you have to like second guess, like, oh, well, you know what? I wanted to hire this guy. He's competent, but you know what? There's a more diverse candidate. Let me hire the diverse candidate because it meets this metric that I need. And I think that's wrong. Like I would rather people judge me based on the content of my character and not the color of my skin. And that's unfortunately, that's not what a lot of these DIE initiatives are about now. They're saying, look, we don't have enough of this race in our board, so we need to do that. Like, it was really sad watching the hearings in Congress, and literally every point that they were asking Jerome Powell, the Democrats, well, there haven't been any Hispanics on the board of directors, so maybe next time you hire someone, make sure it's someone who's Hispanic. Like, really? The economy is melting down, and you're questioning like the diversity of the candidates? Come on, guys! Like, this is what we've turned into as a society now, and I hate that. And that's speaking of someone who's a person of color. I hate that. You know, maybe you guys are afraid to say it, but I'll say it for you. I think it's stupid to have diversity initiatives. I would rather have initiatives around competence where people who are the competent, they get the job. That's it. Point done.
Kris is going to get a call Monday morning from his boss that just finalized the budget for DEI initiatives. Like, so we heard you were on a podcast.
No, I mean, I completely agree with that. I think, look, and even looking at it from an investor point of view, the main goal is to maximize ROI. And if you're making decisions that are not focused on that or are not purely meritocratic in that sense, you're not optimizing for that, then, you know, obviously that's not the optimal decision.
Okay.
Who's buying Sofi tomorrow?
Yeah, I was going to say that. I was going to say,
Go ahead.
Noto bought 180,000 shares. Tanner, what are your thoughts on that?
I think it's exciting. I like when he buys. You know, like Kris says, there's no higher amount of shareholder alignment that he would like to see. But I do think it's just a calming thing. He's a rich man. He can throw $1 million to calm some nerves.
That was a good catch, Tanner. That was a good catch on your part with the guy from Twitter. He's like, "Oh, Noto bought 5 million," and you were like, "No, he actually just bought 1 million." But good move anyway.
That's actually Jedi Kris. He's changed his
Jedi Kris.
yeah.
Yeah, that was the Kris guy that you had argued with.
What, Chris Hoger?
Yeah,
Chris Hoger.
Yeah, his name is Data Driven Investing now. That's his tweet.
Ah, okay, interesting.
Tavis, what did you think? What did you think?
What a dumbass.
Yeah, I mean, I think like Noto just always seems to buy at the best times, and last time he bought in December, it was literally the bottom. I think he caught it within like 10 or 15 cents of the actual bottom of the stock before the market turned around in January when everybody else was like tax loss harvesting back in December. Noto's buying. Now, you know, I think that I'm not sure, but obviously it's coming at a great time, especially considering SVB, but also considering the whole Department of Education lawsuit and a lot of the negative backlash that they got around that. And so, you know, he just continues to renew confidence. And
I think this is something he had to do today because SoFi is a neobank. A lot of people are not going to be as deep into it as us. We're going to, you know, they're going to think, oh, it's going under, blah, blah, blah. And a narrative can form when the CEO says, nope, I'm going to put $1 million of my cash into the company today. Out of old days, it was the best day to do it. I wish Carp or Teal did this randomly for Palantir, and they never do it, you know? So
yeah, I do think you're right. A lot of people think banks are banks and don't understand the difference in the exposure. And he obviously likes buying the stock with his own money anyway. So I think it was just great timing. If we are going to wrap up soon, I'd love to say also potentially why the FDIC stepped in so unbelievably fast for SVB, because I think it's a good way to round out while we were talking about SVB that we didn't actually talk about, because usually these things unfold over a month or two, and this happened in less than 48 hours.
Okay, you got it.
So actual, chartered banks are required to report a lot of information to Federal Reserve systems on a daily basis. Okay. This could be things like reserve requirements, deposits and withdrawals, transactions, interest rates, everything along these lines. Practically all the big numbers that they need. But the two first ones that I said there, which are, reserve requirements and deposits and withdrawals, that's really where SVB really messed up. And I think it was actually management's fault. I think that if they wouldn't have done that mid-quarter report and actually stirred this up, they might not even have had that big of an issue. A 15% dilution in their actual shares could have been the end of this whole disaster. But it turned into this massive domino effect where they said, okay, we had a problem. We're going to fix this with selling common shares, 15%. So we balance it all out. We lost 1.8 million. We'll fill it back up with 1.8 million. And then people go, okay, well, I don't want this to keep going, so I'm going to get my money. And then people, then say, hey, maybe you guys should withdraw as well. This is actually compounding the problem, right? No more deposits, but now your existing deposits are not even there. So this is all just one big domino effect. And the truth is as well is that the people that you're actually investing with are not average consumers like, grandparents keeping their retirement savings. These are very quick to act founders who really, really want to make sure that the success of their business happens, automatically. So bankers were working overnight to fulfill new orders, new clients like JP Morgan. There's an article that they're talking about how it was just a constant, phone ringing off the hook for new clients coming in all night. And so this sort of panic that they started by putting out this mid-quarter report had them to actually report, the next day to the Federal Reserve that they said $42 billion had left the company in a single 24-hour period. 42 billion. Okay. So all of these founders are taking their money out of the company and then they go, okay, well, how many reserves did you have to actually fulfill these 42 billion? Well, not 42 billion. They had a negative number. I forget what it was. It was negative 900 million or something like this. They had a negative number that they reported to the Federal Reserve. That does not happen. The Federal Reserve's not okay with that. So they took the keys away from the car, right? This rent-a-car banking or, chartered bank is ours now. You go sit down. You're done now. You crash the car, right? So it's just insane how fast this happened because of the panic that they already ensued themselves. And the fast acting clients that they actually had.
I wanted to show you guys First Republic real quick, just to show you what a risky situation looks like, because I think it's very important. Can you share my screen, Amit, real quick?
You're not sharing. You're still sharing the stream on that screen.
No, that's fine. It's just that screen because there's multiple slides. So if you guys look at this, right, this is what's on the balance sheet at First Republic. Right? They've got in non-interest bearing checking accounts, they've got around $62 billion. All of this is in $1 million. Look at the cost right now for average weighted capital. This was in 2022. They didn't pay any interest on it. This was pretty much free money sitting on their balance sheet. Then you have interest bearing. So they barely paid any interest on it. Money market, 2.6%. Money market with passbook, 2.3%. And the CDs that they had were 3%, right? So a total of $176 billion in assets that they have. But here's the thing. All of this money can be pulled relatively quickly. Look at the difference in 2021. They had 70 billion. Now they're down to 8. Why? Because why would people keep your money in a bank that right now is just pretty much not giving you anything in interest? Why not put it in Sofi? Why not put it in JP Morgan, etc., right? On the other hand, if you look at where they have all of that money, $136 billion of that money is sitting in real estate secured mortgages. So right now, if this bank has a run on it where people are like, hey, I want my money back, what do you think happens to this bank now? Yes, they have a whole bunch of other things, but they only have $4 billion in cash right now, right? They actually had to come out and do an 8K and say, oh yeah, we have ability to borrow from the Federal Reserve home lending thing for like $60 billion. The problem is when they borrow that money, it's not going to be at 0% like they're getting their money on right now, right? It's going to be with much higher interest rates. So this is where you have a systemic problem. Now, let's say they need to clear off that inventory. They have to start selling things off. This is where all their stuff is in. So if you look at this in hybrid rate and fixed rate mortgages, ask yourself this question, all right? And this is a question that should be on everyone's mind. All these people that got mortgages in the last 2 years and refinanced, right? They got those great rates, 2.7%, 30 years fixed. Who's holding all those mortgages? Right? Which banks are holding all those mortgages on their books and right now have to pay depositors 3, 4, 5% interest? You don't think that's a problem that's coming around the corner?
Tanner, you're laughing. Why are you laughing?
I just like his smug little smile. He's like, "What's your counter, huh? What are you gonna say?" No, I mean, like I said, there's reports that came out that Pacific Western Bank said that they, their phone was ringing off the hook. First Republic Bank did not say anything along these lines, but I assume it's the exact same thing, that they are seeing probably a massive influx of clients right now that were old clients that SVB had actually just happened. I think that buys them a lot of time. Billions of dollars worth, you know what I mean, of new inflows. This might as well be a new 2020 style time when the inflows are just absolutely insane because you have, $200 billion trying to get out of there and go to some of these companies. They're going to make their way to First Republic and buy them time and hope that you can put that money towards extremely high, rate treasuries. Now you can get, potentially 4 or 5%.
Well, Tanner, why would you put money in First Republic when they're not giving you interest, whereas treasuries, they're giving you 4 or 5%, even on a 3-month treasury? Why would you do that?
Well, you're talking about the actual fixed income borrowers, people that are looking for that money. I'm talking about the actual customers who are, trying to flee their money into a new bank.
Right. So why would they go to First Republic and why wouldn't they go to a bank that's higher rate of interest?
Well, because the discounts are going to be higher at First Republic.
Like Sofi?
They're going to keep lowering their rates until they find a buyer. And now I don't know the fixed income market as well as, some bond specialists that we could probably have on the channel one time to, explain this to us. But there will be a buyer for First Republic's issuance. That will happen. It's just at what discount?
What do you mean? I'm saying, look, I have $1 billion right now, right? Like, let's say I was able to pull a lot of my money from SVB, right? Why would I put it into First Republic when they're not even giving me interest on that money? Why wouldn't I put it with JP Morgan, who's giving me a better rate of interest? And who I know has a lot more capital than SVB. SVB only has $4 billion in liquid cash right now.
Why would you choose SVB?
Not SVB, sorry, FRC. Why would I put my money in FRC versus JP Morgan?
Guys, we just went full circle, right? Like, it's either you get a higher rate or you get the security of saying this thing won't go under and you go with the big boys.
I agree.
Yeah, but FRC is once again a regional bank. They're not like, oh my God, they're all over the place, right? And if you look at most of their assets, they're illiquid assets. Why would you put your money in a bank that has illiquid assets backing it versus someone like JP Morgan who has way more liquid assets on its balance sheet?
If I'm correct, FRC is like in the top 10 banks, though, correct, for assets under management?
No. I mean, maybe in assets management, but not in terms of like liquidity.
I think they're even bigger than SVG or SVB, if I'm correct. So that's all I'm saying is that, like, obviously they have a product that people are choosing over JP Morgan in the first place. If founders, they're not just looking to buy treasuries because they need to, use that money actively. You know what I mean? So it's
but like JP Morgan will give you more money actively if you just keep their money with them. Like right now, Sofi, you could put money with Sofi.
I don't know that to be true.
Yeah. What I'm saying, you look it up. These are the Goldman Marcus right now by Goldman Sachs is giving 4%, right? How many other banks right now are probably saying, let's juice it up, let's give 2%, 3%, 4%, raise that liquidity, raise that capital, put it on so that we have all this money sitting with us and not at First Republic? Why did First Republic's deposits go down from 70 billion to 62 billion?
Well, because the entire VC market is drying up. I think that's one of them, right? But now what I'm saying is I still think the market is dried up, but a large pillar of the business is coming down and there's going to be a lot of catching on the way down of these clients. I think for now, they're definitely going to stay alive. I can't say definitely. I don't know the company well enough. I haven't looked into their balance sheet. I predict that because of the amount of $42 billion that got out of there yesterday, from what I heard from Pacific Western is that their phone, same with JP Morgan, their phones were ringing off the hook for clients trying to store their money. I assume if they're going to Pacific Western and, FRC and SVB, I'm sure their balance sheets are extremely alike. I don't think that SVB was doing something that FRC is not. You know what I mean? I find mostly banking is a very similar model across the board.
Tannor, can you answer this question? Will this incident, thank you for the super chat, James McGuire, will this incident be the catalyst of a rash of bank mergers like in the mid-1990s?
Potentially. I don't know. You know what? I do think that there will be, for SVB, there will be a waiting period and hoping that assets get to a disgustingly low period and they're going to buy them all up, and there'll probably be a couple people that end up purchasing them. If there's more banks during that time that are in hot water right now, privately meeting with JP Morgan, Credit Suisse, Goldman Sachs right now, they could potentially be wanting to escape this terrible, public event and try to get out now before something happens, and they might only have a 4-month extra runway or something along these lines. But
I also
this is something I can't predict.
To James's question, I also think that there's like a diminishing returns factor. Like if you already had bank mergers in the 90s, that means that you're less likely to have more, at least bank mergers with the big boys, because they've become already very big. So it moves away from a perfect competition to more oligopolized.
Well, I was definitely thinking more along the lines of acquisitions,
Like
less mergers. Yeah.
Yeah.
Just big guys buying up small things. I don't understand the antitrust for large banks or finances. I don't see how that could, I never understood how more capital can make you more compelling. With finances, a dollar is a dollar. I don't care if you have 100 trillion or 100,000. You can't offer a higher rate. It's very hard to do that. And I mean, there is bundling efforts, but still, that's why SoFi can still be compelling versus a JP Morgan. It's a dollar is a dollar. They're all playing with the same interest rates for the most part.
Okay, I think we're coming up on the end of the pod. I have to share a clip that John Sarge tweeted at us literally 20 minutes ago. It has already been clipped. It is tweeted. This is the 13 seconds we got to do to end the pod. The clip is called Kris Gets Roasted. Here we go.
What are you talking about? I have Palantir certification, bro.
Kris actually literally just got his Palantir certification. He literally just got it.
Oh, okay. Got you. Yeah, no, I'm a Google employee too, because I got the free online course. Okay. Listen.
So that's gonna be, we got to make that clip iconic going forward.
I thought it was definitely going to be the Riley comment, but I didn't realize how terrible my mic is. I apologize, everyone.
No, it's not too bad. You're good.
I'm on vacation. You're getting Florida Tannor right now, so.
Yeah, Tannor uploaded a video, his most recent video. He's not wearing a shirt, so I encourage everyone to go watch the video. And then he made a joke about how he's in Florida, he's getting Tannor, and I spit my food out. I was just like, this is hilarious. This guy's Chris Rock level at this point. This is amazing.
Here's the question: what do you guys think is going to happen next week? Do you think there's more contagion? Are we going to see other banks start to go down?
I think it's going to get ugly. I mean, these startups are not getting their money back. Things are going to get ugly. I don't know what that means, but
I have a few questions. Like, how many startups are actually going to be like completely destroyed by this? How many people are going to be looking for new work? And will this change like anything in tech? Do we do banking in a different way? It's probably going to be some regulatory like action or pandering, or I don't know. Like 2008 had a lot of changes to the system that we have now. What do y'all think?
Yeah, unlikely any regulatory change in my opinion. And even if we do see something, it's going to be this long drawn out process of having hearings as to how this happened. And everybody has their own virtue signaling little agenda during those hearings. And inevitably, nothing really gets done.
My question is, how many public companies have exposure? Because that's where the question is going to be. Look at Roku. Roku's put out a press statement and said, look, we had this much money. How many other 8Ks are going to be filed in the next week saying, hey, sorry, guys, we had a lot of money with SVB. We didn't mean to, but, we fucked up.
Maybe it would have been filed by now. Maybe it's not too many. Who knows?
Huh?
Maybe it would have been filed by today. Maybe it's not that many. Like the worst of it has already happened.
They have 200 and something billion dollars in assets under management. Somebody owns them. I guarantee you it's not a bunch of ideas that are holding $200 billion. There's going to be some huge companies. I'm like, even what I'm thinking, this is a company that I really like, and I feel, sad that this is happening, but I guarantee you, well, I don't guarantee anything, but I have a feeling Shopify is definitely going to be on that list. I have a feeling that Coinbase is definitely going to be on that list. Circle is on that list, and Coinbase these guys are tight. So Coinbase is probably definitely going to be on that list.
So you know who's not going to be on that list? I just put it in our private chat. Amit will be very, very happy to know this. Just tweeted 3 minutes ago by Amit's favorite person.
Oh yeah, this is my guy. I need this guy to invest in my company. I'm pitching him on Monday.
So, Dia is fine. We just use it for example throughout this pod, but
Jason says, I do not have exposure to SVB via my fund or personally. However, we have a couple of portfolio companies that do. This is very hard on a large amount of rank and file workers and the already. Yeah, I mean, look, the guys who are investing 25, 50K, that's basically pennies to them. I think they're going to keep investing. This is more for companies that are going to lead $100 million Series D round. I mean, those deals right now are probably not going to happen, I would imagine, for the next couple months until this gets sorted out.
Yeah, companies that were raising through SVB, I feel really, really bad for. Like, even if you get all of this locked up for a bit with FDIC, it's completely gone frozen. Like it's going to be terrible for the companies. You might have to cut staff. They could ruin the whole company's growth trajectory. But that's what happens when an entire industry is centralized to a couple players.
What I hope
we're obviously really well connected. Go ahead.
I mean, what I hope is that this does not lead to the decline of startup culture or startups in general, which I don't think it will, because America is pretty resilient, and LPs, they don't want crappy returns from the S&P. They want to find the next Uber. So, I mean, I think that that risk-taking culture is not going away from capital allocators, but it doesn't seem like a Silicon Valley bank will ever form again and be as centralized, as you said, as it was. I mean, maybe it does. Who knows? When things get frothy again, maybe the same mistakes. Like as you said in the beginning of this pod, things are so cyclical. And like in 2021, everyone feels on top of the world. Like saying Tesla was going to be at 200 at this level, right, in 2021, you would have sounded like an idiot. You would sound like someone who doesn't understand what's going on.
There was some news about Rippling. Did y'all hear about that? I just want to mention it before we go.
Yeah, Rippling is a payments company that does a lot of payments and HR benefits and payroll through Silicon Valley Bank. So they've got a lot of shit to figure out.
So people that are not don't even have their money in Silicon Valley Bank are going to be affected because their payroll software is not going to even work. So, this is going to be so much news here in the next week. It's going to be super fascinating and sad.
I think every company is going to have to drop a statement saying they have no exposure. And I think that's going to be the telling thing. Because at this point, if you're saying you don't have exposure, you're good. But if you don't say anything, that's worse. Because that means that you could have exposure, right? So every company right now out there is probably having to make some statements saying, hey, we either do or we either don't, So is it from a CEO standpoint, do you think it would be a good idea to say, hey, we don't have exposure, or just to leave people to assume that you didn't have it?
Yeah, I should put out a tweet tomorrow, like an official press release for Audia.
You should do it right now. You should do it right now. Do it right now, live.
I would like to report right now that we have no exposure to Silicon Valley Bank.
If you even put the cash tag of SIVB, you get so many more people actually looking up the company than you ever would. So you might as well just say you don't have exposure.
Yeah. I mean, from your Audia account, just go in and be like, we don't have exposure.
We do not have exposure. Shout out to Rapica for the £10. How much can this recession, if indeed is recession to the globe, it's gonna be like 2008. So I mean, we're about to end the pod, but if you just fast forward, reverse the beginning, we talked for the first 20 minutes. If this is like 2008, I don't think it's like 2008 because this bank is not like Lehman. It's not as big as that, so it shouldn't. But it could.
Hold on. I'll say this: we'll know more next week. 2008. 2006, a lot of this stuff was happening, but until everything started to come ahead, no one really knew. Like, this is the first salvo of something that's coming. And if this doesn't come out and be really bad for the next 2 weeks, then maybe we have a little bit of breathing room ahead of us. But next week, I expect to see some major waves in the market. Let's just say that.
And just to tag on to that, like the end of that super chat, having a big chunk of cash on the side is never really a bad thing, especially in times like these.
That's why Palantir has 2.6 billion in cash. Just saying.
Yeah. And speaking of cash, how are we getting donations in pounds for a midstream, but I get fucking Thai bots?
Well, Kris demonetized it by playing margin calls. So
yeah.
I feel sorry for the guy that donated the 10 pounds for Amit to say rewind it. So
no, because that's a long. We talked about it. He just came in late at the pod, but.
If you're looking for a full refund, just email payments@audia.com. They'll get back to you. The staff there are amazing. So,
what was I about to say? Kris, are you so you're gonna keep buying Weight Watchers for some reason?
Oh yeah.
You're buying Sofi. Okay, awesome, great. That's great.
No, I'm not buying Sofi. I'm buying Weight Watchers, dude. Weight Watchers is gonna be a really good company in the next couple of years.
Kris, Weight Watchers was around. I got commercials on TV when I was 5 years old. Like,
okay,
why are you? What is?
I don't want to turn this into Weight Watchers Weekly, but
you have 20 seconds. What is the TLDR? 20 seconds on Weight Watchers.
20 seconds.
Just look up GLP-1 agonist. GLP-1
no one's
agonist.
looking that shit up, bro. No one has the mental patience to do that.
Knowing Kris, what's going to happen is this company is going to like drop by 50%, and then like 2 weeks after that, Weight Watchers is going to do a $40 billion buyback or something. Like, and then he's going to be right. He's going to make 100%.
I mean, no, just GLP-1 agonists. They're basically weight loss medication. You take a injection once a week. They help people lose weight, like maybe, and this one, some newer ones that are coming out, like Manjaro, it's almost 22% weight loss in a very like narrow period of time. No, these are like a next generation of drugs that are becoming really popular, especially with celebrities and now with like individuals. And Weight Watchers is going to be on the forefront of that, because now they just acquired a company, like a telehealth company, that lets people talk to doctors and get prescriptions for these drugs. They're relatively new, but the market is huge. Like about 48% of all Americans right now are obese, and they could benefit from products like this. And Weight Watchers is probably going to be in the head of this. They're very low in terms of float right now. Their market cap is really low, especially from where they were. They've got Oprah on the board. Trust me, it's a no-brainer to me.
True. She's been using them she's been an ambassador for them for like years now.
Just look up GLP.
To like the Novo play, right?
That's exactly, like Novo Nordisk. Novo Nordisk is one of the main manufacturers, the pharmaceutical companies that owns one of the GLP-1 agonists, which is Ozempic. Like, you guys remember the commercial? Ozempic. That's one of them. Yeah. And then they have another one that's Wegovy that's out there. But this is a pharmaceutical play where these guys are going to be able to monetize a lot of their existing consumer base and get them on plans that pretty much help them lose weight and basically pay the company. So the company's going to do very well in the next few years. So that's why I'm buying.
All right.
Okay.
I have a friend who's watching, and they texted me. And they said, I have a friend whose mom is a VP at Weight Watchers, and Kris is in for a ride. I don't know if that's up or down for a ride, but that's the text I got.
She's a what at Weight Watchers? She's a what?
A VP.
VP.
I don't know if it's up or down a ride. I didn't ask for clarification because I'm not buying Weight Watchers, but
I guess we'll see. I guess we'll see in a couple of years from now, right? It's not a large position that I have. It's just, I think that they're onto something. I've been bullish on GLP-1 agonists for like about a year now, since they started to come up, and a lot of them are coming up for what is that thing called? For approval for obesity
FDA?
Specifically. For FDA approval for obesity specifically. Until now, a lot of them were approved for diabetes care, and you could use them off label. But now, especially if you're able to prescribe them specifically for obesity care, they'll end up doing really well.
If anybody wants to look up another
USDC, wow.
Coinbase paused USDC.
Isn't USDC getting depegged? I think Michael commented that it's like 97 cents, which it's giving me like Luna PTSD.
Breaking news: Coinbase pausing all USDC. Wow. I mean,
I think so. Is this as a result of Silvergate?
No, it's because 25% of.
Go ahead, Riley.
Oh, did you say Circlegate?
Oh, Silvergate.
I don't know.
Does Kris have a YouTube channel? Yes. Type in Kris Palantir and he'll pop up. Also, his Twitter's in the description. I've never been pegged before, but this idea of them USDC being pegged, it's very interesting to me. That
Whoa, did you say you've never been pegged before? What the fuck?
It wouldn't be a SoFi Weekly without one of these comments from Amit. Golden showers. I mean, come on, man.
Every time people are like
so good. An hour and a half, we did so well.
Every time people say stable coins are pegged 1-to-1, or I just think immediately about
Bro, what have you watched? What kind of what's your browser history look like? That's what I want to know.
I just had to say it to see Tanner's face. I go back to these pods later in the night and I go back to reverse to when I say something crazy and I see everyone's face. And it's incredible.
I mean, it definitely livens up the pod for sure. You know,
that is true. Okay, so I guess Coinbase is doing some crazy stuff. Another story that's developing, and we'll see how that.
Well, it's because USDC is by Circle, and Circle has 25% of its cash in SVBC, Silicon Valley Bank.
We are temporarily pausing USD conversions over the weekend while banks are closed. During periods of high activity, conversions rely on USD transfers. We plan to recommence. So Monday, they're opening it back up. That's what they said.
Open slide 4 real quick, because that's literally, it shows on that chart that USDC is at the very bottom, Circle USDC.
Yeah.
Some sort of percentage. I saw it was like 26% on Twitter before we went live. Anyway, this has gone on too long. I'm about to die.
All right. Follow everyone in the Twitter and the YouTube, please. In the description, if you got any value of this, please check out everyone's Twitter and YouTube's in the description. It means a lot. Kris, thank you for hopping on, giving some more clarity, and we'll see you guys next week.
Thanks, everybody.
Thank you, everybody.
Bye, guys.